Hey Scott, what's up, man?
Hey, Chip, how's it going today?
Going great. Excited
Good.
to spend a little time with you. This is normally the time when I would record my monthly video, but got blessed today with your email in my inbox and thought it might be a good time just with the way things have been over the first quarter, but also, with what we know is coming later in the year, might be a good opportunity for us just to jump on and talk a little bit about kind of the market as part of this month's video. I will come back to what I will call the hide your kids, hide your wife message that I've got for later in this year. If you remember the old internet, I guess, meme from a few years ago. But so I will still touch on the non-market component of what I was going to talk about. But I thought it'd be good for us just to spend a few minutes talking about kind of the market. Share with me a little bit about kind of this month's email, and for anybody who hasn't read it, what your thoughts are with regards to where we are in the market right now.
First of all, I have to assume that everyone has read it, right? But if they just want a refresher on what the email said, it basically we're coming off of an amazing streak since October of up days. The market's up 28% from its October lows. We've I don't think until this past week had as much as a 2% pullback in the S&P 500 over that time period. So it's been a great run. So not at all surprising, as it mentions in the email, that volatility is to be expected, especially after you have a big run like that. So it's been great. Our outlook still for the intermediate term is good. At short term, you can see things sort of looking flat, maybe even a little bit soft for the stock market. And I don't know what really will be the pivot point to turn that around. I assume it's going to be all based off of inflation numbers and the Federal Reserve. Um, because what set this all up was, starting in November, the Federal Reserve was talking about how they thought they were done with you know, the regime of raising interest rates at their regular meetings. And in fact, they would look forward to starting to reduce interest rates. So the market just took that and ran. There were a lot of projections out there that'd be six interest rate cuts, in other words, 1.5% in cuts from the Fed this year. And so the market just, of course, they loved that. They thought, man, this is great. We're going to get all this good growth, and with lower interest rates, that's perfect. And the market really just ran, and we went in from all these fears of inflation that was expected, or not inflation, but a recession that was sort of expected, into now fears of or hopes of a soft landing. There won't be a recession, and the market just took off. That's what kind of precipitated that 28% rise from October on until just recently. Now we've had some inflation numbers come out, and they're called sticky, right? Because it looks like inflation is stickier than what we thought. It's going to stay around for a while. The bottom line on that is, I think at least, that the reason inflation's sticky is because everybody's got a job. Everybody that wants a job has a job. And as long as that's the case, um, there will be demand for goods and services. And as long as that is the case, inflation's not going to just drop back to 1 or 2% like we were accustomed to prior. Now, it's still not too high. It's, I think, in the 3% range. I don't remember the number exactly, but it's not terribly high. So we're headed in the right direction. Um, it's nowhere near where we were the other year with peak eggs, but uh, still higher maybe than what we are accustomed to, higher than what we thought it might be at this point in time. But I think it's a number that we can all live with pretty comfortably.
Well, at least going forward, right? For a lot of the the idea of, and we've talked about this probably in some sort of recording before, the fact that inflation slows back down to 2 or 3% doesn't mean that prices are going to go back down. And I think that a lot of us are still dealing with sticker shock. I went in a convenience store yesterday, and I was going to go see the talent after she got off of work, and went to grab her. She likes plain M&Ms, so I went to grab a package of plain M&Ms. It was king size because I wanted to treat her right, because that's how I roll.
Yeah.
And a package of king size plain M&Ms was $3.09. Now I finally reached that age where I started going, all right, I'm just not going to pay. Now I did for the M&Ms because they were
Okay.
for the talent, and that's
Right.
completely different.
Right.
But it doesn't mean that my M&Ms are going to get cheaper again. Like we're going to have to deal with and adjust to the prices of some things right now. So it doesn't mean they're going to go back down. But what I'm hearing you say is that what hopefully we can do now and continue going forward is take a breather from the fact that tomorrow or next week I'm going to go in there and the M&Ms are going to be $3.49 instead of $3.09, because I think that's been, at least for me, and you and I have talked about the fact that we haven't historically like price shopped every bit of groceries. But you pay attention now. All of a sudden, the prices have gotten high enough on a lot of things that you're paying attention. And a big part of that, at least for me, is what has felt like a dramatic increase quickly, so that I didn't have time, or I'm having to really readjust to things. Does that sound
Right.
right?
It does, for sure. It happened very quickly really after the Fed started pumping all the money into the financial system in order to kind of stave off negative effects from COVID. I mean, it's understandable why they did that. You got to keep the economy and the financial system going. But maybe they were a little bit slow in raising rates, which led to inflation being higher for longer. I do have a little bit of bad news for you, and that is on your M&Ms. So the price of cocoa has just skyrocketed. There's been any number of things that have occurred, and unfortunately, chocolate prices are probably going to be high and stay high for quite some time. And you're right, the fact that inflation's lower on everything except cocoa doesn't mean that prices come down. It just means they don't go up as fast. Yeah, think of it when you're driving your car, and if you're going 65 miles an hour and you get to a school zone and you got to slow down to 30 miles an hour, you're still going forwards, just not at the same rate of speed. And it's the same, works the same way with inflation. It's a rate of change.
Sure. And again, I think that sticker shock of a lot of things has been, one of the difficult parts. It's interesting, though, again, just kind of anecdotally, that during that same period of time, other things that have gone up obviously have been equity prices, which means for the average person, if they have a 401k, an IRA, if you have a lot of clients have a large part of their, we'll call it liquid net worth in retirement accounts, those have gone up a lot. So have home prices. So if a lot of our clients, for example, are homeowners, you've seen appreciation not just in the price of the cost of inflation isn't just in the goods we buy every day. And again, correct me if you think I'm wrong. It's not just the goods that we buy every day. It's also in our asset prices. But the price of goods that we're having to buy right now hurts worse than the benefit of the asset prices, because for a lot of people, the asset prices that have gone up are in less accessible areas, being as they are perhaps reserved for retirement or their equity in a home you live in. So going to the grocery store and having to spend more on that stuff hurts more than we probably feel like we gain from our house value going up, because we're not selling it right now. So in that regard, it doesn't matter that our house value has gone up. What do you think?
I think you're right. And in fact, it may work the opposite way, in that home prices having gone up may, people feel wealthier because their home value is higher, or their 401k is higher, or whatever. That makes them more apt to spend, which of course pushes prices higher when you have more people willing to spend more money on the same amount of goods. So, yeah, that may actually work to cause more inflation rather than less. And you're right, no one's pulling a brick out of the side of their house to go buy king size M&Ms.
No, but if they did, they can drop the M&Ms off at my house, because we obviously have established a need for those.
Yes.
The other thing I read recently is, while none of us like inflation, those of us, folks who are working, who have gotten any kind of cost of living raise or increase, it actually is a bit of a self-fulfilling prophecy in that part of the cost of goods, in fact, in a lot of cases, a substantial part of the cost of goods above and beyond raw material is labor. And so it's a bit of a things cost more, so employers raise wages because folks need more money to be able to keep up with the inflation, which then perpetuates some of the inflation. So there are a lot of things kind of to unpack there. But as it pertains to us as investors, I'd have to think you're touching on how things have been good is one of the one of the things to point out, and the other is for those of us who are savers and investors, higher interest rates, which has been in response to trying to tamp down inflation, have also given us higher rates of return on particularly short-term, whether it's savings accounts, CDs, money markets, those kinds of things.
Yeah, that's right. There are options now. Finally, you can get north of 5% on savings type instruments, perhaps not FDIC insured, but savings instruments. And it's caught up finally with sort of longer term or intermediate term bonds. At least I'm looking right now at a 10-year treasury yield at over 4.5%. So you can even lock money up for a longer term with pretty decent returns. And that really is part of the reason why the market reacted so negatively this week is interest rates have moved up a lot from lows back at the beginning of the year. And that's worried some of the stock investors. And I think that's the one thing that if you're out there, if you're looking for, where maybe are the sort of where the problem spots, we want to keep interest rates in a moderate area. And again, I'm talking more of the 5 and 10-year bond kind of range. You don't want those going up too high. They were considerably higher in the middle of last year. I want to say we got north of 5 or maybe even 5.25% on those 10-year treasury bonds. So they were higher. Came all the way back down below 4 and now have shot up to 4.5. That's really unusual volatility in bonds. You almost never see that. And I think that's been unsettling to stocks as well. It's a spillover from bonds to stocks. So I think we'd like to see that stabilize, somewhere in the 4 to 4.5% range on those 10-year bonds, maybe even come lower. I think that would be welcome for stocks because it's just less competition when, if bonds are yielding 3%, fewer people are buying bonds. Most likely they're going to do something with their money. And, that could well go into stocks. Maybe the dividend from a stock can make up for the income lost from lower yielding bonds. So any rate, the stock market likes it when there is no alternative, when you can only buy stocks really because interest rates are low. We're not in that environment right now. We have alternatives. There's good alternatives out there to stocks, frankly.
Yeah, well, and I would think too, for a lot of folks who are balanced investors who have a more balanced portfolio, not all stocks, when interest rates drift back down, right, bond prices will go up, which means that, for those who are already invested in bonds, a decrease in bond yields in interest rates would drive improve the pricing, the asset pricing, which for, again, folks with balanced funds or a balanced kind of an overall allocation will actually, in addition to potentially being good for stocks in terms of there being no alternative, it could also be good for the current holders of bonds. So, and again, that's one of the things you and I have talked about is, the fact that while the stock market has recovered, and that's what they talk an awful lot about on a lot of the national news, you haven't seen the same level of recovery in a balanced portfolio, and that's because of or would you agree that's because the continued high interest rates and really the need for those to come down to see the improvement in a more balanced portfolio be more in line?
Yeah, I think that's part of it for sure. If we saw interest rates come down, you'd definitely see the prices on your bonds and your balanced portfolio go up, which would be nice. The other thing too, and I think most investors are aware of this, it's been a really heavily concentrated market. there's been, they call it the Magnificent Seven, and you can argue how many stocks are actually in there, whether it's 5 or 10 or whatever. But most of the performance has come from an extraordinarily small part of the market. I've seen statistics that say that the market has been more concentrated over the past year than at any time ever. It's not necessarily a bad thing, but if you're comparing your balanced portfolio where you do own some bonds and you do own some small cap stocks and you own some international stocks, everything that you would do to make a diversified, balanced portfolio, I mean, if you're comparing that to the S&P 500, it's going to be a really difficult comparison because they just haven't been the same thing. And I don't think certainly any investor, I would not recommend that any investor that has already accumulated a lot of money be concentrated in 5 or 10 stocks. That's a great way to make a lot of money, but it's also a great way to lose a lot of money. And so I think that by and large, most investors probably are more in the mode of they're not trying to lose a lot of money. And it, so again, almost everybody has exposure to those kinds of companies because again, we're looking at Apple and Amazon and Google and Facebook and things like that. But not everybody has all their money in those 5 or so stocks. And that's okay. Usually, these things are cyclical. Eventually, the other 490 stocks will catch up to the top 10 in the S&P 500, and it'll end up working out over a cycle. It can be painful over the short term, though, to look and say, why am I not up as much as the S&P 500? And it's because you're not invested the same as the S&P 500. That's not a good thing or a bad thing. It's just a fact.
Sure. Well, and again, it goes back to the old, if you want to get rich, be concentrated, especially if you want to get rich quick. Concentration will help with that. If you want to stay rich, diversification will help from that. And again, a lot of folks that we work with are in much more the second camp than the first. So, you touched on kind of what to expect in terms of the market, kind of the idea that at least the trend appears still to be positive, though with momentum. Any other thoughts more forward looking? Anything else that I didn't ask about?
We've talked about stoplights in the past, and
Oh, yes.
I'll use a different traffic analogy. Well, and I'll repeat one that we started from earlier in this conversation. That was the school zone. I think we were going 65 for a while, right? That move up from October. Now we're probably in a school zone, but the school zone ends, right? It ends after however quarter of a mile after you get past the school or whatever it is, and you can speed back up to 65. I think based on what I see right now, I think that we'll be out of the school zone before too long. And rather than coming to a stoplight, we'll be able to accelerate again and head back up to 65 miles per hour. But for now, I think, just kind of deal with the fact that maybe we are in that school zone. Thankfully, now this time, what's different is we're going to get some yield on our safer investments, the bond and bond-like investments. So finally now we can, even though we might be going a little bit slower, at least we're going to be collecting some interest and dividends. And then we'll be able to speed back up. I think is the most likely direction. Again, that could get derailed if inflation heats back up. I don't think that's likely. It's possible. And in fact, the scenario that we're in right now is exactly what we thought would happen this year is you'd have this growth scare of, you hear soft landing, soft landing, soft landing, inflation's coming down. And then all of a sudden there's some numbers that are contrary to that. So now is everybody scared? Oh gosh, are we growing too fast? Is the economy too hot? So we readjust our outlook based on that. And in the end, we think we do come back to that sort of soft landing place where the economy does well, but it's not overheated. And we get back to a really good performing economy, likely accompanied by a good performing stock market.
Well, and I would go back to what I was originally going to talk about. It's an election year. We've talked about this before in lots of different venues. Likely, in my opinion, it's not likely. In my opinion, it's a given that it'll be the nastiest, craziest, loudest for some people, scariest election cycle we've had in my 25-year career, if not ever. And I would, and so there may be some increased volatility. So to use your example of the school zone, I would throw in that the volatility, particularly as all the noise comes in over the next 6 months, is kind of like traffic. So we may be in a school zone with traffic, meaning we have to slow down, speed up. There are obstacles and there are kind of additional potential distractions. You and I, Scott, have talked before about my weapons of mass distraction that I think we're going to see really ramp up between the national media, your social media platforms, and just the internet in general, and that bid for our attention, I think, is going to, again, when I joked earlier about the hide your kids, hide your wife, what I mean specifically in this particular case is guard your attention, because we've got a lot of folks who are going to be vying for our attention. The vast majority of it's going to be negative, and we pay, for good or for bad, our brains are wired to pay extra attention to potentially threatening things. So negative information sinks in quicker and stronger probably than a lot of the positive information. So we'll continue to do things like this, and of course to be available as a resource for our clients, their friends and family, to be that other side, that reinforcement of the positive side of things. Because again, so many people want so much of our attention. I read a statistic yesterday. In 2020, political spending was $14.4 billion in 2020. Wouldn't surprise me, just a guess. You could tell me it would be 20 billion this year, and it wouldn't shock me. And so anywhere you go outside of literally the present and the real world, somebody has dollars trying to influence you in one way or another with some sort of message, most likely negative. So be present, be where you are. I think one of the things I've said before is, focus on talks, not tweets, and read books, not blogs. Something that's gone through a filter, something that, again, you can feel like has some longevity to it, and as little, everything's got probably some sort of spin to it. But particularly when people are paying for it, there's a story behind it, and it's the story that they want you to buy into, because ultimately it ends up meaning more money or power for them. That's neither good nor bad. It's just true. And so again, kind of my message is control the things you can control, and don't lose focus. Pay attention to the important things, and guard your attention from all the people who are wanting to buy it.
Yeah, great points. It's easy to be scared if you watch national news or listen to the candidates speak. It can be easy to get scared, but I don't know. It strikes me that there's a lot more good than bad. We just
Well, especially today, right? It's 78 degrees and sunny in Florence, South Carolina, or whatever it is outside. Right here, I'm good. And that's what I find. I keep reminding myself, wherever I am, 99 out of 100, 990 at my confidence number of things being good right where I am most of the time is really doggone high. And so, again, for a lot of our folks, people who are watching, I would just suggest be where you are, focus on what's important. And Scott, if they have questions, they can call us.
That's right.
Awesome. Well, Scott, look forward to it again. Look forward to your email in my inbox
It'll be there
next month. And I look forward to talking to you again soon.
Sounds good. Thanks, Chip.
Take it easy.